Welcome back, everyone. I want to talk to you about something that's really, really important. A few days ago, we had one of the most important economic data points, and that's the PMI Index. But before we go there, I want to talk to you about my biggest mistake. I do all this research, and I figure that I leave no rock unturned. And I thought that interest rates would go down and there would be a recession like months ago, not now. And so I'm speaking in November of 2023. So I thought there was going to be a recession earlier. Why? Because I did not have access, and because I didn't have access, I didn't consider that we had a huge amount of excess savings. Some people estimate that savings of between 2.2 and 2.5 trillion dollars from the Biden administration. It is huge. And what happened is the recession was delayed. The ball was kicked out further and further because we have so much excess savings, and there was very little data on this. I did find something here from the Federal Reserve Bank of San Francisco, and this goes back to May of 2023. And if you read this paragraph here, I'm going to highlight it, or try to highlight it. It says here, estimates suggest that those funds, those excess savings, have been available, but they're going to be starting to run out around now, the fourth quarter of 2023. I'm going to show you a chart here of the excess savings. You could see it right here. It's unbelievable. It's huge. You could see how much excess savings we had. And now you can see, so the pandemic savings were here where my pointer is, and you could see now it's going to be turning into the red in 2023. And so because of that, the economy has been stronger. But I am here to tell you, I'm putting a line in the sand to put my reputation at risk that now is the point in time when the economy starts slowing down. So we had very strong GDP growth of 4.9% for the third quarter of this recent third quarter of 2023. I think that's going to be the peak of economic growth, and then we're going to slow down. So we're not going to go from plus 4.9, obviously, to negative growth because it takes time. The U.S. economy is like a big cruise ship. The ships don't turn around quickly, right? They turn around slowly. But nevertheless, the U.S. economy is going to turn around from plus 4.9% growth to maybe half of that, and then maybe negative growth next year sometime. So what I want to show you here is this came out on, there's no date here. It was a few days ago, basically. And what it's showing you is that the PMI Index, the Purchasing Managers Index, which I've been following since I was a little boy. Back in the 80s, the mid to late 80s, I've been following this report. That's when I started following it every month since that point in time. And why was I so interested in this report? Because it's been a very good predictor of economic growth, including recessions, going back since it came out. I'm not sure when, but probably in the 1980s. Maybe even earlier than that. So this data is very bad here. So when it's 50, it means, or 50 and above, it means the economy is growing. So we're below that key line. I'm going to blow it up for you. You can see yourself. So here you can see it's saying at 50%, at that level, at that survey level, at 50, the economy is at break even, meaning it's not growing and it's not declining. But now we're at 46.7. That means the U.S. economy, in terms of manufacturing, is declining. So you might say, but this economy is not a manufacturing economy, and you are correct. Manufacturing is probably only about 30% of the U.S. economy, but the Purchasing Managers Index is a very good indicator of the overall U.S. economy. And remember, there's a lot of economic dependencies. So even though the manufacturing economy is small, there's a lot of other industries related to it, even service industries related to it. It's almost like energy. You ever hear people talk about what the CPI index is before and after energy, like excluding energy? But even if you exclude energy in a consumer price index, it kind of seeps in there. as a feedstock into other industries, into the overall economy. So you have to be very careful reading that data. So I'm going to show you some data that really scares me. Number one, it scares me that this index is so low, and it was lower than it was estimated. I think the previous month it was 49, and for October it's 46.7. And the estimate was for about 50, I believe. So it's much lower than the estimate. That's one really bad sign. The second bad sign is the new orders index. You can see it right here. I'm going to blow it up in case you can't see. The new orders index was only 45.5. That is really bad. Okay, yes, we have the strike at the big three, Chrysler / Stellantis, Ford, and GM. But even excluding the effect of that major strike, it's still a very low number. The production number is low. The employment number is low. We're going to talk about that later. And inventories was scary low at 43.3. And what else? And the backlog is very low. So this is all really bad. So this is the first canary in the coal mine saying that there is going to be a recession. Now, I want to before we talk about the U.S. economy in terms of employment, I want to talk to you about the other 2/3 of the economy, which is the services economy. So the services PMI is still good, but is below the estimate, and it's declined from last month. I'm going to open this up for you. Enlarge it. And you can see it was 53.6 in September, and the recently released report is 51.8. And you can see inventories are low, the backlogs okay, export orders declining because we know there's weakness in Europe, right? And in China especially. So I would say this report is okay. But again, the one I look at as a bellwether index is not this one. It's the manufacturing report. Now let's look at employment. So today as we speak, the labor report came out, and it was weak. The labor report showed that, I'm going to put my pointer here, is that there were 150,000 non-agricultural jobs being created. That was lower than the 170 jobs created and lower than the previous month. Let's see if I could get it here. I don't know. Well, here it's saying it was flat, but basically it was not a good report. And if you go to, so this is the beginning of what I think is going to be softness in the report. You can't see it in this chart. It looks like we're just going up slowly, but this was indeed a weak labor report. And if you drill down, you can see why this weakness. You can see that most of the jobs this report here has shown the change in jobs by industry. You can see most jobs were services jobs, and you can see here services jobs grew 160,000. Here's another service job, education health services, and government jobs were strong. I don't look at those jobs to determine whether or not there's a recession. I want to know what's going on outside of that. I want to know what's going on with professional jobs. I want to know what's going on with manufacturing jobs and mining and goods. And those were not good. So the labor report was not good. And here is another way of looking at the jobs report in terms of growth. And you could see in purple that you had a lot of jobs being created in private education health services. And the same thing with leisure and hospitality. So again, if you're looking deeper into the numbers, they were not good. If you look at the unemployment rate, it ticked up yet again. It's still a very low number, but it ticked up again. I think it went up from 3.7 to 3.8 to 3.9 over the last 2 months. So that's not good. And if you look at anecdotal information, such as information coming out of corporations like Bill.com, a lot of people don't know this. This is a cloud service provider. The stock went down 25% because they had to sharply reduce their outlook because of what they're calling a weak macroeconomic environment. And only yesterday, Paycom went down 25% or so, and another 2% today because, again, they had to reduce their outlook. So there is anecdotal evidence that there's weak macroeconomics coming from businesses. And we saw this also from consumer staples companies like Heinz and all kinds of food-related companies. I mean, they're blaming GPL drugs like Ozempic, like weight loss drugs, for their weakness. But I think it's more than weight loss drugs. I'm seeing weakness in businesses in their third quarter earnings report. Not in their earnings reports for the third quarter, but their outlooks. They're usually like beat and raise. Now it's beat, and they're putting on some cautious outlooks. And even Airbnb was down. I think they were down 5% a few days ago because they had a good report. But again, they're worried about war in Ukraine, war in Israel and Gaza, and they're worried about global macro uncertainty. And if you see here, I mentioned to you earlier, the U.S. economy grew 4.9% in the third quarter. But I think this is going to be the top. And I mentioned to you one or two economic indicators. Actually, I mentioned to you one. I mentioned to you the PMI Index that was indicating that the U.S. economy is going to slow down. Another one, which has been 100% accurate in the past. And this, when I say past, I'm not talking about the last 10 years. I'm talking about going back to the 60s and 70s. This indicator, the leading economic indicator, has had 100% accuracy at predicting recessions. And if you look here in blue, that's LEI, it's going down quickly. And it went down in 2020 and predicted a recession then, predicting a recession in 2008, and it predicted a recession back in 2001. And you could keep going back. So this has 100% prediction accuracy. So when they speak, you should listen. Now I want to talk to you about another predictor. This is the 210 spread that everyone talks about. This spread has been negative. And when it's negative, it predicts a recession. And the joke is that it predicts the last 13 of the last 11 recessions, meaning it's sometimes predicted recessions when there were not recessions. But I think it's going to be right this time. And if you look, let me just move it over a bit so you can see it. I'll make it smaller. If you look here, you can see that it's at negative 31 basis points. So it's negative here, the 210 spread. And it was negative back in 2005, 2006, and negative in 2000, and negative in 1990, and going back to the 80s before those recessions. One thing I failed to tell you is that these indicators are sometimes 1 to 2 years ahead. So what happens is when you finally get into recession, the 210 spread actually reverts and starts going back up. And you can see here that it's going back up now, but it's going back so that the spread is no longer as large as it was before. Basically the 210 spread was something like 100 basis points. Now it's only like 31 basis points. You can see up here, I've got my pointer there. So that's typical. People forget, but when we enter a recession, again, the 210 spread actually starts rising and reverting back to normal. So just be careful there. And so what happens to the stock market when LEI is negative and the 210 spread actually reverts back to normal? The stock market actually starts going down. So people wonder, why is stocks so strong now? Because interest rates are going down. When interest rates decline, investors interpret that as a good thing, right? Because stocks do well, and even Bitcoin and crypto and liquidity do well. And global liquidity is rising right now because of China and Japan. So the stocks do well when liquidity is rising and interest rates are declining. But what happens is, as rates keep going down, investors start getting scared. They're like, oh my God, maybe this is not a good thing that rates are declining. Maybe it's indicative that the U.S. economy is going to start declining. So that's all for today, folks. I hope I didn't confuse you. There's a lot to say. I'm going to review what I was saying. Number one, the PMI survey is finally declining. And to me, that along with the LEI is indicating a recession is coming. Number two, or number three, I should say, the 210 spread is indicating we're going to get a recession. And it's going to take some time. And that was my major mistake. There was high excess savings, so it's taken even longer for this recession to occur. But now I'm putting a line in the sand because the PMI Index is declining rapidly. So that's your key indicator, that and the labor market. So I hope you enjoyed this, and forgive my losing of my voice, but I had a lot to say and I'm recovering from a cold. So I hope you enjoyed this, and good luck, and enjoy this short-term rally because it's not going to last. S&P, you know what, let me go show you here. The S&P, I thought would go from 4,100 to maybe 4,450, and that's what's happening. If you look here, I'm going to go back to a year. We were 4,100, my indicators became bullish, and now I think we could get to around 4,500, but no more, because what's going to happen is you're going to see more and more data, economic data, and businesses report that they're seeing a slowdown. So just be careful. Enjoy the ride, but sit by the emergency exit. Well, thank you all, and have a good day. Bye-bye.